Hey guys, it is Friday, June 16th. This is your Friday update. Apologize for being a little MIA on the updates. My attempts to switch to a different platform required a little bit more effort and training, I guess, to get used to putting some different things onto YouTube in a way that actually looks good. So still working on that, but we will have we're working on getting a bunch of videos and educational things. Program information and terminology and different things posted here on the YouTube side to kind of build that up for you guys to be able to share with your clients and for your reference as well. So lots of stuff going on. Interest rates, of course, are still, a little bit high, but that's just kind of where we're at right now. We are running about 7-ish, a little bit higher sometimes, low 7s. Sometimes you can get into the high 6s, depends on some timing. And as always, depends on the structure, of course, paying points or not. Again, my position personally is not to pay discount points to buy down the interest rate right now. It's almost all loans are going to end up being refinanced in a short amount of time. So paying discount points right now to get a slightly lower interest rate is not really going to pay off in the next 12 to 18 months before somebody's going to refinance that loan. So that's kind of our position on that. But interest rates are expected to still go down. The outlook is still the same. Moves around just a little bit. And so sometimes some of these things with market reports and what's coming out and when and why and all of that does change the timing of it. But the expectation and the outlook is still the same. Interest rates are coming down. Expected to be in the 5s, towards the end of the year, into the fall, and maybe towards the end of the summer if we get through some of the things that we need to see. So expect to see that start to happen here. We do have to get through a little bit of pain here to figure out what the banks are going to do, and so I'll touch on that here in a second. But that's kind of where we're at right now. Lending is still available. Some of the thoughts and conversations about tightening really hasn't really affected very much. So it's just really tight inventory. Home prices are staying steady, if not going up, because of the tight inventory. And then interest rates, of course, are stubbornly high. And that has to do with some of the stuff that's going on with the banks. So if you need anything, feel free to reach out to us. I'm available this weekend. You know how to reach me. You can call me, text, email, whatever you need, and we can get you guys taken care of. So if you want to stick around for a little bit longer, kind of give you a little breakdown of why interest rates are being stubborn and staying high. The reason that interest rates are sticking around where they're at right now is we are getting all of the inflation numbers and economic numbers and jobs reports and things like that coming out in the way that we want them, and the expectation, of course, inflation coming down, that's going to help interest rates get better. And that is happening. We are seeing those reports. They are coming out as expected. The downside is, of course, fallout essentially from 2008. So I've spoken about this to a number of different people earlier this morning, to a group of real estate agents, yesterday as well at a broker open, to a bunch of different real estate agents. 2008 caused quite a few issues, right? We all know that. It also put into place some regulations and some calculations that have to be accounted for with the banks. And in February, we essentially we were found out that calculation and things that they're using for the stress test, it's flawed. They put a number there instead of a 3-month treasury. And they should have been looking at that because the 3-month treasury moves. It's actually very closely follows the Fed funds rate. So when the Fed started raising interest rates, they should have changed the calculation on how they're doing these stress tests, how they're doing the calculations and the valuations with the banks. And they didn't, because they had a number there of 0 instead of, let's say, 3-month treasury that changes. So not realizing that, of course, caused some issues. And now the banks have to reevaluate their balance sheets. And what we're seeing is when the reports come out and inflation numbers go down, economy numbers are coming in and slowing, interest rates should be getting better, and they do as far as bond pricing goes. But then a bank somewhere decides, hey, we've got to unload some mortgage-backed securities, and they're selling off. And so interest rates do get a little bit better, but then they get a little bit worse in the afternoon, and so we're kind of staying flat. So we've got to work through that. Once that's all worked through, then we will see those benefits of inflation coming down and the economy slowing and interest rates getting better. So I hope that helps answers any questions. Feel free to share this with anybody you need to, or if anybody has any questions, feel free to reach out to me and I'd be happy to go over it with a little bit more detail. Hope you guys have a great productive weekend. We'll talk to you guys again soon. Bye.